Well, welcome to our YouTube live, and we're going to be together for an hour. And I think this really is the last YouTube live when we'll be below 100,000 subscribers. So I think in the next 2 weeks, we're probably going to hit 100k. We didn't quite manage it by Laura's birthday, but we're not far off. So a belated birthday present for Laura. And let me just recap on some of the stuff we've been talking about recently. So since the last time we had a YouTube live, I've done a video on cryptocurrency yield farming, and that was interesting because one of the good things about being a small channel is, or a relatively small channel, is that I can still do experiments to see, what kind of things people are interested in. And what's interesting is that the people who watch my channel hate crypto. That's pretty clear. So I had a lot of pushback and people saying I'm going to unsubscribe, but I still think it was worth talking about, because I think when you're yield farming and you have a stable coin, it's interesting to see that the yield you can generate with that is still pretty high, and much higher than you'd get with a normal bank account. But obviously you're taking much higher risks with it. So I was really clear in the video that, the capital's at risk, and it's a much bigger risk than putting your money with the bank. So I still think that was interesting. And then the post that we're doing this week, so I've just finished a video talking about hedge funds, what they are, why, the kind of strategies which they use to make money, and why in some cases they blow up. Also, the members question for Patreon supporters this week was about lessons that I learnt while working in investment banking. And that was quite a personal video, but people seem to like that because, obviously having worked in the banking industry for a long time, you kind of see a lot of stuff happen. And I kind of was there during the financial crisis, so I talked about that. So yeah, 5 lessons from investment banking for Patreon members. And so anyway, tonight, if you could subscribe, if you haven't already subscribed, that would be great. And also, if you like our stream, that would help us a lot, even if you're watching in replay. And other than that, you can always have a super chat in order to be pushed to the front of the queue for me to answer your question. Or if you're a supporter on YouTube, and you can do that by clicking on the join button underneath this video if you're on your computer. If you click on the join button, then you get a nice crown next to your name, and you also get the joy of knowing that you've supported us and making sure that we stay independent, and that we can afford to eat. Always a bonus. And so let's start off on the questions. I think we've already got a question from one of our supporters. Hisham Daoudi says, hello. Hi, Ramin. I have some money which I want to dollar cost average into equity over the next 2 years. Would it be wise to keep some in cash instead of bonds to avoid a potential taper tantrum in bonds? Yeah, I think, look, if there is a taper tantrum, then the hallmark of a taper tantrum is that they tend to be fairly short-lived. Now, it might trigger something bigger, but what happened in 2013 was the big shock was the first announcement. And then every time something happened after that, there was a diminishing shock. So it's when the Fed first says, look, we're going to do something, and we don't know when it's going to happen, but it's going to be soon. And that seems to be the biggest shock when it happens. Equities sell off when that happens. The dollar usually strengthens, but in this case it weakened. And then at the same time, bonds sold off. So that's what you're worried about, I think, Hisham, which is that bonds and equities sell off at the same time. However, that usually lasts a very short period of time. It certainly lasted a short period of time in 2013. It was just a couple of weeks. And so I really wouldn't worry too much about the effect on kind of reasonable duration bonds. If we're talking about 10-year bonds, you'd have a duration of about 7 years. And the drop in the value of those would be fairly negligible, I suspect. we at the beginning of the year, we saw a big sell-off in long duration bonds in particular, but we've recovered a lot of that ground since then. So I really wouldn't panic too much about keeping your money in cash. Maybe if you think it's going to be, so the reasons why I might keep it in short duration would be more to do with when we get a very strong GDP print in the United States, and we're looking at almost 2 digits. That's incredible. Before the crisis, we were talking about 3-4% GDP growth. Now we're talking about 9% GDP growth in the US, which is kind of EM rates of growth. It's faster than China was growing before the pandemic. That would push up yields, and that I would be worried about. But that's a much kind of longer term trend, I suspect, to grind upwards in yields. But that could take a while. And I also did a video on the kind of midweek video I did this week was about what's going to happen for the Fed. And I looked to see what was happening to the US unemployment rate. And the US unemployment rate has a very rapid decay, which in this case lasts about 2.5 months for it to halve. But 80% of that is already kind of done. But it looks like the remaining 20% is really slowing down. So it'll take a long time for that scarring to heal. And my estimate is if it's like the previous financial crisis, it'll take about 3.5 years for the remaining 20% of the unemployment rate to fall by a half. So that means that it'll probably take a couple of years before we reach the Fed's full employment target. So that's why I think it's unlikely the Fed is going to hike, even as soon as their dot plots tell you they will. So I really wouldn't panic about rates rising very quickly. I think people were just too panicked about that and too panicked about inflation rising. Certainly the bond market is looking through the inflation story. Equity markets, not so much, but I think that bond markets are a fairly good metric when you look at inflation expectations. So I really wouldn't worry too much about that. But look, if you are worried about increasing rates, then just go for short duration. Cash is fine, or short duration govies. Either is pretty similar. I really wouldn't panic about it. But personally, I'm keeping my long duration bonds. I didn't sell them when they crashed at the beginning of the year, because I know those will rise in value if there is a significant equity sell-off, and that gain will be what I use to buy equity when equity markets crash. That might not be in 1 year, it might not be in 2 years, who knows? But that's what I'm keeping my long duration bonds for. Anyway, so that's what I'd say. So going back to the questions, I think that's it for supporters' questions. So I'll start answering questions from others. Sushi Truk says, "Thank you for your great video on yield farming." Oh, somebody liked it. There you go.
Lots of people liking it.
Okay. How is it possible they can give such high return? Where does the money come from to give such a rate? Yeah, I mean, this is exactly what I was wondering. I think one of the things it's being used for is lending out. So I think there's a demand from institutional investors to do various things. So I talk about this on the video, but if they're going to use leverage, they may use borrowing of stablecoin to do that, or perhaps they're going short. Maybe that's what they're doing. But whatever the reason, they certainly seem to be generating a hell of a lot of yield, which suggests to me that there is a huge risk. It's just that we don't know what it is yet. And that's what intrigues me. And for stablecoin, where the volatility is 1%, and you're getting a yield of 6%, then on a risk-adjusted basis, that's incredible. So with Nexo, where I could keep it in sterling stablecoin, their version of it, I'm generating very high returns with almost no volatility. There is risk there. It's not volatility risk. There's platform risk. There's plumbing risk. There's operational risk from Nexo. maybe that's what's responsible for the very high yield. But still, I thought it was interesting that you can get such a high rate. And of course, Nexo is very quiet about how they generate that yield. I think BlockFi is more transparent, but still, you know, they don't break it down. They don't say this is where your return came from. But yeah, I still think that's a story I want to follow, and the best way to do that is to have skin in the game, which is why I actually invested some money yield farming myself, because otherwise, you know, you never really know until you risk your own money. So hopefully I won't be sobbing to the camera in one of these sessions saying I've lost all my money for the from the yield farming. Right, Alex says, are gilt and treasury ETFs a sensible idea now with negative poor returns, high prices, tapering coming? If so, what specific ones, not long duration, would you point out as the best ones on Just ETF? Okay. Well, like you said, I mean, you've kind of answered that yourself, which is if you think yields are going to go up, just don't go for the long duration ones. But you don't have to go for corporate. Yeah, I mean, you could always go for corporate bonds, or you could go for sovereign bonds. Both of those generate higher returns. Both come with higher risk. Of course, there's a very clear trade-off between risk and return. And if you're lending money to governments in emerging markets, obviously that's going to have a higher credit risk because they do sometimes repudiate their bonds. And if they repudiate their bonds, then, you know, you could make a capital loss. So you'll be lending to countries like Mexico, Brazil, Russia, for example. But that's why you earn a higher return on those sovereign bonds. But there are several to choose from, several of those EM sovereign bond funds and high yield credit. So I did a video on high yield credit. Again, you know, now is not the time to buy high yield credit corporate bonds because credit spreads are very tight. They have widened a bit over the last couple of weeks. In fact, why don't we have a quick look at that? Interesting. Let me just pull that up on Fred and then I'll share my screen. And here we go, credit spreads. And I'll just share my screen so you can see. There we go. So hopefully you can see that. So what you should see here are the spreads on corporate bonds in the United States, and it's broken down by rating. So the tightest spread, the smallest spread here, is the compensation you receive above US Treasuries for taking the credit risk of US AAA companies. There are only two of them, Johnson & Johnson and Microsoft, which are AAA. And then it goes to triple B, double B, and single B. But what I'm talking about here is this very slight widening of credit spreads. And that's the first time we've seen that since the March sell-off last year. So you can see spreads widened during that when there was a bit of a credit wobble. But then the Fed started buying high yield bonds and investment grade bonds, ETFs, and those tightened very rapidly. But only recently, over the last couple of weeks, or last week or so, you can see the credit spreads widening. Not a lot, just a bit, but still interesting. And if it continues, obviously that would be worthy of a video, I think. So at the moment, credit spreads are very tight. You're not being compensated to take US credit risk. The time to buy corporate bonds is at periods like this, when the credit spreads are wide and you are being compensated for the risk and nobody else wants to buy them. So if you want to be a bit contrarian, that's the time to buy high yield bonds. So that's on my crisis shopping list, to buy corporate bonds, but also maybe EM sovereign bonds. So those are both potential shopping list candidates for me. So back to you.
Gary.
Okay. So back to Gary. Oh, Gary, brilliant. So Gary says, just a few months ago, there was talk of a commodity super cycle. Even you made a video addressing it. There we go. Are we still equally optimistic? So certainly, you know, that's done pretty well. I mean, I don't usually talk about my trades or boast about the returns I'm getting, but that one's doing fairly well. So let me just get that trade to show you. Where is it? Here we go. So the fund I bought when I made the commodity supercycle video in February was this one. Let me just share that with you again. And here we go. So this is the fund I'm talking about. It's the Legal and General longer dated all commodities UCITS ETF. So I bought around February time after the crash, and maybe it was March. But anyway, you can see that the kind of return over that period of time has been pretty good. Not astronomical, but pretty good. But it does seem to be kind of fizzling out now. So if I just draw the return on that, just so we can quickly see what the percentage is, that's up by about 65% since the post-March crash. I think I bought in February, which is when I made the video, so I'm only up about 40%. But still, you can see that trade is still slowly grinding higher. But in terms of whether that trade's got further to run, I certainly think it does for the time being, because if you look at the opening around the world, then the Delta variant is still kind of keeping activity limited in many countries. So there's still a kind of break on commodity prices, and we still have the spending on infrastructure feeding through in the US. So it's a kind of front-loaded 8-year program by which the US is going to build bridges, charging points for their electric car network, plumbing to ensure that there are no more lead pipes. And all of that requires, firstly, directly it requires things like copper, because if you're building infrastructure, it requires copper, concrete, glass, and indirectly it also requires building supply chains. So I still think that's got further to run. But so I think yeah, it could have further to run, but most of the wins may be over. I don't really time these things, but personally I'm thinking about taking the trade off now, because I think it's probably the quick wins are over. So, but yeah, I think the commodity super cycle, if it is a super cycle, it's supposed to last an entire multi-year period. We're talking about 10 years. So this could be the beginning of something which is much bigger. So maybe I will let it run. I don't know. This is part of my fund portfolio. My core portfolio just contains boring things like equity and bonds, and I try to keep it to 2 or 3 funds in that core fund. And then my fund portfolio has all sorts of nonsense in it. So this is a small exposure to something which is fun. And I certainly wouldn't commit too much capital to commodities, because they are typically quite volatile, but also very unpredictable. Whereas equity is fairly predictable over the long term. So there we go. Back to Slack, I guess. Yep. Nope. So back to YouTube. And the next question. So remember, you can like our stream. That helps us. You can do a super chat, and then we'll answer your question first. Or you can always subscribe to our channel. That way you won't miss more content that we produce. Maria says, intrigued by ETF's spectacular performance this year. Its code on ETFDB website is BDRY, Breakwave Dry Bulk Shipping ETF. It's based on futures on shipping. Any idea why such amazing returns this year? Oh, let's have a look. That sounds interesting. So this is BDRY. Here we go. ETFDB. Here we are. So again, let me share my screen so you can see what I'm looking at. So now this is one of the things that's always interesting to look at, is the cost of shipping stuff across the world. The reason why it's interesting, let me just log in actually, because I do pay for ETFTB. There we go. So let's see what index it's tracking. Breakwave's dry weight futures. Let's see if we can find the actual website. Breakwave dry bulk shipping ETF. So I was hoping they'd give us some kind of breakdown on the index itself. But as a macro strategist, this is one of the group of indices that we used to look at, because obviously global trade requires stuff, physical stuff, to be shipped from one side of the world to the other, so that when there's a greater demand for this kind of shipping and it costs more, then you get, it's a kind of read on how much global trade there is. And also it's a kind of index which is hard to fake, because it's a physical thing, and it's a fairly transparent market. So indirectly it's a read on the global commodity market. They say to other major assets, but I suspect what you'd find is that it is cyclical. So when the global economy is strong, then you'd expect this thing to do well. So let's have a look at the fact sheet, see if it gives us any other. So it's got a kind of nice global map which shows where the shipping routes are. So a lot from Asia so Australia ships commodities to China. As you can see, these two shipping routes here. Then we have reciprocal trading routes from Europe to China, and from China and Japan to the US. So you can see the exporters are in dark green. That looks unlikely. Yeah, so anyway, that's kind of interesting. But that's the way I take it. If this thing's been doing well, then that suggests that there's a huge demand for shipping containers, and usually that would happen if there's a spike in commodities, or because there's a big demand for commodities, or for some of the finished goods which are coming from the Far East to developed markets in the West. So it's interesting that this thing's done incredibly well. And you can see the 1 month performance, 28%, 3 months, 73%, and year to date, it's up almost threefold. So, yeah. But anyway, if you want to learn about shipping, there have been some brilliant episodes of Odd Lots, which is one of the podcasts which is done by Tracy Alloway and Weisenthal. I've forgotten his first name, that's odd. Joe Weisenthal. So those two do a brilliant podcast called the Odd Lots podcast. Odd Lots podcast. And they've done some really good ones on shipping. So definitely worth listening to that if you're interested. But yeah, this is the way I'd take it, as a kind of indirect commodity, and indirectly a kind of cyclical indicator. And this is exactly what you'd expect if the world's opening up again and commodities have to be shipped to supply increased demand for commodities as people manufacturing gears up again, and the world recovers slowly from the massive synchronized shock that we got with the pandemic. Okay, so let me shift back to me. There we go. And back to the questions. So Peter says hello. Hello, Peter. Multiform says, hi, Ramin. I hope everything is well. I was wondering, is there an equivalent to Portfolio Visualizer for UK funds. It would be very helpful to compare portfolios of Vanguard funds or others, for example. Yeah, I mean, I use SharePad for managing my portfolios, and I was thinking of doing a video about SharePad, and so I think that could be interesting for many people, because for UK investors it's pretty good. For US investors, not so good, because it doesn't really cover US assets as well as the UK. But I've been using it on and off for absolutely ages. I first found it when I was a contractor working for a company called CityWire in the previous century. That's when it happened. So it was over 20 years ago. And I've been using it ever since, on and off. And I use it every day now because I use it for PensionCraft. So for time series, it's great, and it does the portfolio management and gives you a breakdown of the return on your portfolio. But it is a pain because you have to upload your trades into it, which is always clunky. And one of the drawbacks is if you get paid a dividend, you have to manually enter every dividend payment so that the cash account is kept up to date. I mean, ideally what you'd have is a system which can speak to some kind of interface from your trading platform, so that whenever a dividend's paid, it automatically enters into your portfolio management system, or if you do a trade, it's automatically entered into the portfolio management system. But for just working out what your portfolio is worth, it's pretty good. It's pretty good.
Link in your description about it.
Oh, Laura says there's a link in the description of our videos about SharePad, and it's also an affiliate link. So I should declare that, we get, I think, a month free if you click on the link, and you also get a month free. And I think if you go for a year-long subscription, you get 2 months free. Anyway, that's pretty good. But I think Portfolio Visualizer works for UK funds as well. I did look at it briefly, and I think it does work for UK funds as well, but I'm not sure. I haven't really looked into Portfolio Visualizer. But are there other portfolio management systems I know of? Not reasonably priced ones. But if anyone else knows, just mention it in the chat so that other people get the benefit of finding out. Right. Slack, yes. Here we go. So Gary's kind of following up on the point about commodities. I'm a bit surprised how everyone is so sure of big infrastructure expenditure in the USA. Biden's plans need to pass through legislative process. Aren't we ignoring a lot of political uncertainty? Yeah, I think while they have control of the lower house, and I think Kamala Harris has the kind of casting vote for the Senate as well. I think while that's true, all they have to do is convince all of the Democrats that it's a good idea to do the infrastructure bill, which is actually quite likely, particularly so early in Biden's presidency, because he's more likely to get people on board. So I think at this point it's looking likely that it will be passed. Republicans, on the other hand, will be recalcitrant. They won't be willing to support him, not in any numbers. But I do think that the plan has a fairly high chance of passing. It's got scaled down already, so I think it was above 2 trillion previously, and it's now being kind of reduced in scope. But still, I think it will be passed. I think it's easy to talk about infrastructure in America because people see it every day. If you drive across a bridge in the United States, they're in an awful situation. They really are. Many bridges which are in a bad state of disrepair. I do speak to quite a few US clients. It's been a while since I was out in the US, but they confirmed that, yeah, the infrastructure is in a pretty dire state. So things like rail infrastructure, which is almost non-existent in the US for passenger traffic, things like the charging network for electric cars, I think that'll be a fairly easy sell to Democrats, maybe not so much to Republicans. So I'm fairly confident it will be passed, maybe in a reduced form in terms of scope, but still, I still think that could be a biggie. But you're right, there is political uncertainty around that. But of course, it's not just the US which is going to be spending on infrastructure. We'll also see that in other countries. China remains a big source of demand for commodities, and their economy is still doing okay. It was never really hugely affected by the pandemic, and so I would expect that other regions will also be building their own infrastructure and also doing their own stimulus in order to recover from the pandemic. So it's not just the US. That's not the only source of demand for those commodities. Okay, so back to the questions on YouTube. Oh, interesting. Okay, so BM365 says, what's your opinion on UK stocks getting bought by foreign investors and private investors, yet as an index still remaining forever undervalued? Yeah, it does feel that way. The UK actually did pretty well coming out of the pandemic. Not initially, but kind of over the last 2 or 3 months. It has kind of tailed off now as the Delta variant starts to cause more concerns in the UK. But certainly for a long time, the UK was underperforming. So for a decade, pretty much it's been underperforming. And one of the videos I was thinking of doing was on the 10-year anniversary for Vanguard life strategy funds. Now, they've underperformed global indices. And a large part of that is because they've got a very large overweight for the UK. And that's been a big drag until this year. Maybe that's about to end. But certainly the UK is less of a pariah now, I think, than it was before. Firstly, Brexit uncertainty's gone. So, we're now pretty much seeing the other side of it. It has had some negative effects on certain industries, but it hasn't been a catastrophe in terms of growth. But it's hard to separate that from the effect of the pandemic. So we will have to wait a bit longer, I think, to work out what the effects will be. But certainly, life hasn't ended here. Very few people said it would be catastrophic, but certainly people do expect it will be a drag on activity for some time to come, but just a fairly negligible drag. And it's always impossible to know what growth would have been if we hadn't had it. But the other effect, I guess, is the weakening of the currency in the UK. There was a hope that that would drive greater trade. But obviously, there's been a much bigger effect from the trade friction with Europe, because 50% of our exports were to Europe and still are. So, yeah, I think it's hard to see why. It's hard to see the catalyst at the moment for why the UK should massively outperform the rest of the world. But will it trade in line with the rest of the world? Probably. Personally, I'm not massively overweight or bullish for UK. I'm not tempted to buy a large holding in UK small caps, for example, which some of the clients I speak to did, and that trade's pretty much waned since about a month ago. So yeah, I think we still aren't seeing huge foreign direct investment into the UK, but who knows? Maybe things will improve. I'm not particularly bullish myself, though. Okay, so next question is...
There's a funny question in Slack from a super chat.
Oh, a funny super chat. We like those. So AJ Bambino, who super chatted us, thank you for super chatting us. Your content is absolutely phenomenal. Thank you. Let's get to brass tacks, though. Who's the better band, The Clash or Slade? Who you got? Well, it's got to be The Clash, right? I love The Clash. Slade, basically a one-hit wonder, Although they are Brummies, I like Brummies because my family's from Birmingham. So I'm tempted to say Slade, but I've got to say musically, I prefer The Clash. There we go. So I've nailed my colours to the mast there. I don't usually make forecasts, but there we are. Okay, so next question. Oh, and thank you for the super chat. That's great. Eric, the video was very much worth it. This is about the cryptocurrency yield farming People calling it a scam. That's right, they did. People calling it a scam was just suffering from extreme confirmation bias. Yeah, it's a real Marmite subject. When you talk about cryptocurrency, people either love it or hate it. But I still think it's kind of interesting. So no regrets for doing the video. Although I think it did actually move us back from 100k rather than move us towards it. Sorry, Laura. Okay, the video was worth it. Yes, the Angry Ed. Hey mate, I don't have tons of money and am open to riskier investments. What are your thoughts on going for funds such as Scottish Mortgage more than index funds? Yeah, actually, Scottish Mortgage is actually on my shopping list for a crisis. Why? Because I just like the way they invest. I still think they're very expensive. You know, they still are priced very high. They had an incredible run, just like ARK funds in the US, leading into the end of 2020 and the beginning of 2021. They were stunned themselves at the size of the returns. But at the moment, I still think that Scottish Mortgage is overpriced. But hey, you know, it's buying a lot of stuff I love. It's buying SpaceX. It's buying it privately because it's still private equity. It's not a listed stock, but they've bought lots. And it buys quite a few unlisted companies, some of which bomb, but many of which go on to become listed and gain in value hugely, like Alibaba. They bought that when it was still private, and obviously that's done very well. So that's definitely on my crisis shopping list. When equity markets sell off and there's a panic, that's one of the things I think I might buy. But would I buy a huge amount of it? No, I wouldn't, because I think it is high risk and it is leveraged and it is high fee. So it stands against a lot of the stuff that I teach people. So I can't, in all good conscience, give it a large allocation, but I just love the fund. I love the governance. I love the board. I love the oversight from the governor. You know, the people who are on the board are very well tuned to the themes in which they invest. And so I get the feeling that the board could stand up to the fund manager and say, look, you're crazy. We're going to fire you if they really screwed up, which some boards simply wouldn't. I mean, one of the problems with Woodford, which was the big investment scandal in the UK, was that the board didn't stand up to him. And they were too scared to do that. And not until it was far too late did they ever turn around and say, you know, what you're buying is complete crap. Which a board should always be able to do. They should be able to stand up to their fund manager and fire them, because that's the point of an investment trust, that you can do that. So I like the governance. I love their themes. I love the way they write about it. But all I don't like is the high fee and the current price. I think it is overvalued, or at least it's buying stuff which is overvalued. So that's on my list. But how much would I put into it? Less than 5% of my portfolio, because it is speculative. There we go. So that's my view on it.
That's a member question.
Oh, member question. How are we doing? We've got 20 minutes. So still plenty of time to like, subscribe, and maybe put it on social media. You know, other people could join us before this hour is out and be amazed at the quality of the content you're sharing. There we go. Okay. Arsenio. Hello, Arsenio. Nice to hear from you again. Says, is it possible to accurately calculate covariance for non-normally distributed variables? Why is the Markowitz mean variance optimization model said to assume normality? Okay, so a couple of things there. Covariance is model independent, just like variance is model independent. It is just a summary statistic, and it's just one measure of correlation, right? But the Markowitz mean variance optimization model does assume normality of returns. So that's the difference between the two. So it's just a difference in the theories, right? So there isn't really a theory behind covariance. It is just a summary statistic which tells you how two variables covary. whereas Markowitz is built on quite a bit of theory, which does assume the normality. So yeah, I mean, it's just the way that the theories work. Arsenio also says, is mean variance optimization with quadratic utility functions still used by portfolio managers? Interesting question. I mean, I know they do, because would they allocate on the back of it? Probably not. There are other methods that people use which are much more sophisticated, Bayesian methods, which people use sometimes to allocate. But the difficulty with those is hardly anyone understands them. Whereas mean variance optimization is just so easy. So, I mean, I use them all the time just as a kind of visualization of returns for a portfolio. And it is interesting to know that if you look back in time, the leftmost point on an efficient frontier would retrospectively have given you a very low volatility way of combining things in a portfolio. So there are lots of just beautiful mathematical theorems that just spill out of mean variance optimization theory. So, things like, you can construct any portfolio based on 2 points on the efficient frontier. Beautiful stuff like that, which is really kind of goosebumpy stuff if you're a nerd like me. It's just too beautiful not to know and kind of cherish. But like any theory, like there's a kind of equivalent for physics, right? Which is Newtonian physics is wrong, right? If you're in a strong gravitational field, then we know that time slows down and you get relativistic effects. But literally, if you wanted to get a rocket from here to the moon, you could use Newtonian mechanics to get there, even though the theory's wrong. Because although it's not perfect, it's accurate enough. And for just doing a plot and just working out a portfolio that's roughly low vol, why not use the efficient frontier for that? But would people allocate on the back of it? Probably not. Not a kind of professional fund manager, no. But you can bet all of the fund managers know the theory, because it's always a good starting point, right? But the risk return trade-off, how to diversify, how a correlation affects volatility, if you have two assets which are correlated or uncorrelated, all of that is kind of basic stuff which should almost be part of the DNA of any fund manager. So they certainly understand that. Okay. But then your final point is he does not say anything about how to calculate expected return. That's right. And that's where the Bayesian theories come in. Because what you have to do is choose a correlation matrix which is consistent with your expected returns. And that's really hard to do. Imagine you've got 20 assets. Well, you've got about 20 times 19 divided by 2, about 200 correlations to think about. Because it scales as the correlation matrix scales as the square of the number of assets you look at. So it's really hard to come up with correlations which are consistent with your expectations of return. And that's what these Bayesian models let you do. You can create internally consistent models. But how do you calculate expected return? You just guess. That's ultimately what it comes down to. You can take historical returns. Maybe that gives you a starting point, a base rate. But then ultimately, active managers will have an opinion, which they overlay on the portfolio, and that's how they make their allocations. Okay, so how are we doing? 15 minutes. Still plenty of time to like, and still plenty of time to support us. So you can click on the join button, and we'll push your question to the front of the queue to answer it. Right, Dan Veneri says, who's also supporting us, thank you, Dan. Do you have any green investments in your portfolio? If yes, which one? I actually don't have any green investments. I use Vanguard as my kind of core platform, and they do have ESG funds. Personally, I find difficulty with some of those ESG funds. Part of the problem, I think, for me is their version of green is not my version of green. So, for example, I'm kind of fine with using molecular biology to create crops which are more efficient or disease resistant. So I'm fine with that. But some of these ESG funds would not be okay with that. I'm okay with nuclear power. I still think that's okay. Maybe renewables would be better, but I still think, if you don't want to have something which is dependent on wind speed, if you don't want to have something which is dependent on waves and tides, then which is easily switch on and offable, then nuclear is a fairly good alternative which doesn't produce greenhouse gases. So, I like nuclear power, but these funds wouldn't. So my ethics are not their ethics. Whereas if I bought an impact fund, which Vanguard doesn't offer, I know that the money I invest would actively be used for things like wind farms, which I would support, or things like recycling plastics, which I would support. So, yeah, I think that's my fundamental problem with ESG, which is, firstly, it's self-reported. So they've taken index, and whichever companies have ticked the right boxes, and you're relying on them to be honest about that, those are the ones which will stay in the index. So I don't think it's very green to start with. It's not my green, and it's not very impactful. So those are the reasons why personally I don't invest in them. But if I did choose green portfolios, I'd go for probably some kind of impact funds, maybe some kind of renewable energy thing. I'm certainly thinking about a renewable energy fund as part of my crisis shopping list. When equities tank, that's the kind of thing I might buy, because those are still expensive as well, alongside ARC and Scottish mortgage. So that's probably what I do, Dan. John MSP, am I pronouncing that right? Thank you for supporting us. How easy is it for fund managers to change horses re-chosen stocks? Interesting question. I think it depends on the type of manager. Now, some fund managers, and this is a kind of increasing trend, I think, they have highly concentrated portfolios with low turnover. So by design, they buy, say, 20 stocks like Fundsmith, and they don't change the stocks that they buy unless the story has changed substantively. And that doesn't usually happen. So these have very low turnover. They pay very little in terms of trading fees. And that means they can charge you less. Their fees can be lower, which isn't true in the case of Fundsmith. It's still charging over 1% or around 1%, I think, is the management fee. But for those funds, having low turnover, very little buying and selling, is part of the design and part of their unique selling proposition. For other funds, where they literally have thousands of stocks and they're continually churning the portfolio, investment banks love them because it generates a lot of trade for the bank. But it's not great for you as an investor because it usually has large trading fees, which ultimately you probably pay for. So I think for some funds, that churn is just par for the course. Usually those are the ones which are kind of more old school. But for the new breed of funds, and Fundsmith's one of the leaders in this, but Lindsell Train is similar in the UK. Cathy Wood's fund is kind of similar in the sense that it's concentrated small numbers of stocks with high conviction for those stocks. I think that's becoming more popular. And also having high concentration shows that you have strong belief in the stocks that you buy, and they're stocks you're willing to hold forever, or at least a long period of time. So I think that's why they're popular, easier to market. And if they perform well, you can believe that the fund manager is much more credible. What you don't want is a fund which is always churning over stocks and effectively becomes very close to the benchmark it's tracking. Because that's the danger. If you're continually buying and selling thousands of stocks, pretty much you'll kind of approach the returns on MSCI Global. So why would you do that? Why would you dilute your own alpha, if it exists, your own outperformance? So I think increasingly it's harder for fund managers to justify churning because people are kind of wise to it. Okay. Oh, another member question, Adrian Cook, who says, thank you, Adrian. Is there a way to generate a fixed income yield of say 4 to 7% with option strategies? Alternatively, could I strategically buy and sell high dividend stocks around the ex-dividend date quarterly? So again, let me just quickly share my screen and so you can see this. There we go. So let's have a look at QYLD. So this is a covered call ETF. So covered calls are the way you usually increase the yield on a fund. So what you're doing here is you're selling the upside of the NASDAQ. So let's say the NASDAQ increases by 10%. You've actually sold that return to somebody else. But in return, you generate premium because when you sell an option, it puts money in your pocket. And then after the expiry date of the option, let's say it's a 3-month option, you do it again. You sell the upside 10% from where the stock is today, and you make some money. And the more volatile an index, like the NASDAQ, the greater the premium you generate when you sell the stock. So for the most volatile indices, like the NASDAQ, you can increase the yield, the dividend yield, massively. So for this one, the trailing yield on this thing is, the distribution yield is almost 12%. So you've got NASDAQ with capped upside and a yield which is very high. And effectively what you're doing is monetizing the volatility of that index. So you could do this yourself with individual stocks by selling the upside, by doing these buy rights, as they're called. So you buy the stock and you sell the call option. So you're capping your upside, capping your upside, capping your upside. When is that going to be bad? Well, it's bad when the equity market rallies strongly because you'll miss out because you've sold the upside. But when it's good is when it's kind of trending sideways, the stock price, or very slowly falling, because then firstly the volatility will probably be high, but also you'll be generating the income. So your total return will be pretty good. The drawback on doing it via a fund, a buy right fund, is this, which is the expense ratio, which tends to be quite high, 0.6, which for NASDAQ is very high indeed. But still, there are lots of these covered call ETFs out there. Not so much in the UK, of course, because we don't have sophisticated products in the UK. Not that that annoys me. It does annoy me. But in the US, certainly you have many buy right funds to choose from. So that might be a way to go for you. So how are we doing for time? We've got 7 minutes, still plenty of time to like or super chat and support us. We'd really appreciate it if you did super chat because obviously it generates income for us. Right. Oh dear, that's quite a rude comment from James. I really enjoyed the video on yield farming. Some old farts. Actually, I'm an old fart, you know. Can't seem to understand new technology, but I thought you laid out their high risks well too. Thank you, James. I appreciate that. Oh, good story. Oh, Sally Franks says, by the way, Slater from the Black Country, and they're definitely more than a one-hit wonder. I'm a proud Black Country wench, though so slightly biased. Well, my family's from Blockswitch, so yeah, clearly I should be more loyal to Slade. There we go. Not just a one-hit wonder. I just love those 70s videos of Slade. They're just beautiful. Next question. in the remaining 5 minutes. Okay, interesting. So Sally also says, what are your thoughts about my strategy of buying high dividend paying stocks that are well covered? And so she's talking about dividend cover. So the company's generating plenty of revenue so that it can easily pay its dividend to its shareholders. And then selling covered call options on them. Oh, I like that. Yes, Sally, that's very cool. It's done quite well up to this year. Up to so far this year. Well, yeah, great. I think that's a great way of doing it. You know, unless the equity market goes on a tear, in which case you'll miss out. But hey, you know, you'd still generate the income. So that's pretty cool.
More question. And where's Teddy?
Where's Teddy? Oh, I put my shorts on specially so that I wouldn't have an unwanted disclosure. That's what an SEC 13F disclosure is, isn't it?
Oh, yeah.
If you're not wearing shorts. Yeah. So let me just get some food for Teddy, because we can't have one of these without. Ted, it's time for your snack, my friend. Are you ready? Teddy's born ready. Got to come over here though. Over here. Ted. Oh, good boy, good boy. Oh, very good. Very good. Right. So Teddy's got to make his star appearance. Good boy. That's the last one, I'm afraid. Sorry, Ted. Okay. So back to the questions.
2 more in Slack.
Oh, 2 more. Right. So we have 3 minutes for 2 questions. Adrian says, a low 30-year bond yield's an indication of slowing growth and a correction in equities ahead. Yeah, but I think a lot of people were surprised by it. I think people had overpriced the amount of inflation which we were going to get. And obviously yields have fallen quite a bit since the beginning of the year. And yeah, I think part of that is growth expectations, but also inflation expectations. Both of which I think got a little bit ahead of themselves. Maybe this is a story about growth. So perhaps we won't get 9% growth in the US. And this is an indication that the bond market thinks growth will disappoint. But I think it's certainly true that inflation was a story that was overdone. And, you know, bond markets are looking through it. So I think it's more to do with inflation than growth. But we'll have to see. You know, we'll have to see whether growth does disappoint. But personally, I think it's more to do with inflation. But would that cause an equity correction? I think probably not. And the reason why I say that is that yields are still low. If yields were like, 5-6% and growth was going to be poor, yeah, that would be a problem because funding costs would be high for companies. But funding costs for companies are at almost record lows. They're the lowest they've ever been. So if we do get some growth and companies can fund themselves very cheaply, then they should be able to fund increased earnings and growth of their earnings quite cheaply via the corporate bond market in the US and elsewhere. So I'm not that worried about growth disappointing. And I'm not convinced that if growth does disappoint, that we're going to see an equity crash. I don't think that's going to happen imminently. John MSP says, how would one use RAF regression analysis? I'm not sure what RAF regression analysis is, to be honest with you, John MSP. But yeah, maybe that's one for Slack. If you're a member, just ask on Slack and maybe we can discuss it. Okay, so how are we doing for time? We're about done. It's at 8 o'clock now and it's been an hour and I'm about to expire from heat and I'm sure Laura is as well. The 3 of us are locked in this quite small room and it's very hot. So I think we'll probably draw a line under it there. So thank you all for joining us. It's been great. Some great questions as always. And we'll see you in 2 weeks' time. You can still like us. You can still give us a thumbs up on the video. And don't forget, you can support us on Patreon and get to talk to us directly on Slack and benefit from all the knowledge of the community members. But thank you all for joining us, and hopefully see you in 2 weeks' time. Bye, everyone.